Good day, everyone. You are welcome to this week's Business and Investment Tips program, a production of Christ Church Radio. My name is Ayodeji Ebo, an investment professional. This week, the attention is on debunking myths about investing. Several people have stayed away from investing due to various myths and misconceptions they believe. This week's episode aims to debunk some of these myths and misconceptions to enable you to take action towards financial freedom. 1. You need a lot of money. This is one of the most common myths of investing. You don't need to have a lot of money to invest. You can start with as low as 1,000 naira in stocks and 5,000 naira in mutual funds. Do you know that if you invest 7,090 naira monthly for 30 years at the rate of 8%, you will have 10 million naira? More important, cultivating an investing habit by starting small and early helps you build the discipline and consistency required to be a successful investor over your lifetime. Do not despise small beginnings. 2. Investing is complex and hard to get started. If you have never invested money before, it can seem not very safe and you may not even know where to begin. But the reality is that it's never been easier to get started with investing. It's simple to open an investment account online, which will give you access to a lot of information about investment opportunities. Most investment outfits produce FAQs as well as articles to help simplify your investment journey. You can also access a lot of simplified resources online through articles and videos. 3. Investing is very risky. Investing is not without risk, but you can fully control how much risk you want to assume if you are the nervous type. Several investments such as treasury bills, commercial paper, bonds, and savings products will allow you to make money without much risk. And it is important to remember that while stocks can go down in value quickly, they have historically always rebounded if you buy stocks with strong performance. You can also diversify your investment to reduce the risk. For instance, you may decide to invest 70% in fixed income and 30% in shares. The allocation depends on your risk appetite and investment objective. 4. The system is not transparent. You will often hear this due to past experiences of some investors in the financial system. I won't suggest that the financial market is perfect, but corporate governance has improved and there are more rules to ensure transparency among the investment outfits. The truth is that for the average person, it's now easy to buy stocks, treasury bills, bonds, and other investments in a straightforward and transparent way and make money doing it. There are online platforms that have simplified these processes. 5. It takes too much time to invest. It's not uncommon to picture investors spending hours adjusting stock screens to get just the right stock at the right time. The good news is that investing doesn't have to be time consuming. You can invest in regulated mutual funds, which are professionally managed. However, you will still need to monitor and compare performances with other mutual funds. Do not lose track of how your investments are performing. 6. Past performance indicates future returns. It's tempting to buy an investment because it has not done well in the past. And it's generally true that if a stock has generated a solid return over a long period of time, it's a good bet moving forward. But there is absolutely nothing to prevent an investment from tanking even after years of great returns. And it certainly does not make sense to invest in something based on the performance of the previous few months. This also applies to mutual funds. The performance is tied to income on the available class of assets as return is not guaranteed. 7. Investment professionals know a lot more than you. We don't want to belittle fund managers and research analysts, but there is a growing body of evidence that no one, not even the most experienced professionals, can consistently beat the performance of the overall stock market. It's also good to have a bit of understanding about the companies we buy into. Similarly, for fixed income investments, it's great to have a little understanding of the instruments to enable you meet your investment objectives. Thank you for listening. Please join us same time next week for another exciting and insightful session. For comments and feedback, kindly forward to ccradio@rccgchristchurch.org or send SMS to 070-8246-3747. Stay blessed.